Oh no, 60% is here. In this video, I'm going to share a little bit about why the bank have decided to implement this. What does it actually mean for us as investors? How could we protect our position right now and still look to grow our portfolio safely? A bit of background: back in 2020, in response to COVID-19 and the potential for a market crash, the Reserve Bank have decided to lower the loan-to ratio for investment properties. Back then, in order to buy an investment property, you needed 30% deposit. Because of COVID-19, they have dropped that down to 20% to increase the liquidity in the market. This opened up the floodgates for second home buyers, and people were able to unlock their equity. Even if they just had a tiny little bit, with 20% deposit, it was very easy for them to pick up another property without actually putting down any deposit. If you want to learn how to buy with just using your equity, there is a video in our channel. You should be able to find it in our top 10. Now, the pandemic also contributed to a surge of Kiwis returning home. Many came back highly skilled, so they were able to find higher paying jobs than they would if they just stayed back in New Zealand, meaning they would have stronger borrowing capacity coming back if you compare them to the local Kiwis who might just have graduated. Coming back with a bit of savings, a bit of help from parents, the natural thing if you had the borrowing power is to look for a home. Straight away you could see a surge in the market prices because there was a high demand for housing. Now you combine that with historically low rates. $1 million in debt is costing you less than $450 a week if it's an interest-only loan. No doubt you're going to see a major price spike in housing. So isn't that happy days for the banks? Unfortunately, a few months down the track, the banks decided that it is unsustainable. Because according to the RBNZ, the demand for mortgages just back in November 2020 compared to the previous year, same month, it was increased by 30%. The 30% equate to about $3 billion in lending in just 1 month. Now think about how many properties that is in a market like ours. Although that's good for business because they have a ton of demand, but they're not able to grow their team as quickly. And so the bank said enough is enough. Now, although the RBNZ, the Reserve Bank, was wanting to remove that 20% rule in March 2021, the banks have voluntarily started removing this LVR rule in November. They went back to 30% deposit in the hopes of the demand slowing down. But unfortunately, it didn't do what it needs to do, because what happens is, even though they have increased the deposit back to 30% for investment properties, the price surge have gone up significantly, negating the effect that the 30% was supposed to do. And so people would run out of servicing, and people would run out of borrowing power before they would even run out of equity. And realistically, if you look at the house prices in the last 6 months, it has gone up in the double digits. And they've got more business that they can handle, so they decide to put the deposit rate up to 40%. The amount of equity that you need for investment property is significantly higher now. And all the major banks have already implemented this, but do keep in mind there's an exemption on new builds still. So you can still buy new builds potentially with just 20% deposit, and house and land package with just 15% deposit. So as an investor, what should we do? This is the time to review your yields, because cash flow is what's gonna help you get through the period if there was any fluctuation or if interest rate randomly spiked up, which I think very unlikely. You should still safeguard yourself. Now, what does it mean by reviewing your yield? You wanna look at the rental income in comparison to the value of your property. Are they still giving you a good cash flow yield? Is there potential for you to swap some of these assets that are low yielding for potentially higher cash flow assets of around the same price and maybe still a decent area? And if you want to learn how you could potentially increase your cash flow without really sacrificing your capital gains, I would strongly recommend that you guys attend our Stage 3 Masterclass in the links below. I would 100% suggest that you do a bit of research. What could you sell your properties for? What are some other opportunities that can give you similar returns with a higher cash flow? Because remember this, even if you have to sacrifice a little bit of capital gains, if you could actually end up in a higher leverage position, your overall capital gains in the long term is most likely going to win on a higher leverage position than you would with a lower yielding asset. In other words, let's just say if you could just buy one Auckland property for $1 million or $2 million of properties in Hastings, the $2 million of properties in Hastings with higher cash flow is going to win in the long term. So definitely do some homework on that. Number 2, what could you do? Restructure your lending and max out on any properties that you can, and try and free up some securities if you can. Just for an example, maybe you have 3 properties and you can actually shift all of that debt onto 2. I would free up one property 100%. This is going to allow you to have more flexibility in the long term. You could sell the property for cash that you can control. You can use that security to negotiate for more lending at another lender. Perhaps you want to buy another holding property, or you want to start trading because the market has a lot of fluctuation. You could sell properties really quickly for a good margin. Or perhaps you want to do a joint venture with your family. Perhaps they got the cash flow and you have a security. You guys could do a property together, and a mortgage advisor can definitely advise you on how you can structure a deal like that. Number 3, I would learn about non-bank lenders. I believe this is going to be a very important channel going forward for property investors and mortgage brokers, because the non-bank lenders are not bound by the RBNZ rules, meaning they don't have to use the 40% rule or the 30% rule if they don't have to, because they might have external fundings from elsewhere. Some non-bank lenders can still lend up to 80% on investment properties. The downside, of course, is a higher risk expects a higher return. So interest rate would be around 3 to 4% for some lenders, and then there are other lenders that might lend 4 to 5%. Again, it's a different profile and different risk appetite. So it's important to have a mortgage advisor on your side that is probably good with properties. Now, if you want to learn more about non-bank lenders, definitely subscribe and stay tuned. We're going to look into those options a bit more in the future. And remember, if you want to learn more in-depth mortgage strategy to structure your mortgage in a way that's going to help you grow, help you protect yourself, increase your cash flow position, then definitely check out our masterclasses in the links below. I'll see you guys in the next video.